Hi everybody, this is Lance from ThetaTraders.com. This video I'm going to go over the collar strategy. This is a good strategy to use if you've held a stock or ETF for a long period of time. It's already up quite a bit. We've been in a bull market the last year and a half or so. So for any shares that you might own that has increased in value from when you bought them, collar strategy could give some good downside protection. Because in a collar strategy, what we're going to do is we're going to buy a put and typically a little bit out of the money. And then you could also sell a covered call against it. Now, when doing this trade, it's usually for a net debit. Typically, the bought put will be costing you a little bit more than the covered call. However, this again gives good downside protection and you could limit your losses. So I'm going to show you some examples and how I might be able to use it. So I'm going to show you an example of how to do the collar strategy on Apple. Let's just say that you've bought Apple about a year ago, possibly under $200, and it's up quite a bit at 237.87. And what we want to do is possibly limit our losses if it happens to drop, but also get a pretty good premium from selling a covered call against it, which would lower the cost of the protective put. So one way to go about this is we're at 237 and change, and you go around 37 days out. And what you're going to want to do is, if you already own the 100 shares, you want to buy a put. I would typically like to look a little bit out of the money here. If you bought a put at the money, it's going to cost quite a bit of premiums to actually buy it. So I'll typically like to look around 0.2 or 0.3 delta. If you buy the 225 put, it'll cost about $253. If you buy the 230 put, about $370 or so. I think both of these options, pun intended, are possibilities that you could look at. Obviously, you want to figure out what your cost basis of your shares were when you bought your shares as well. So let's just look at the 230 put. It's going to cost me about $370 or so dollars. And then we want to find a way to structure this so that you'll be able to get some premium to pay some of that cost. So 237, again, assume that you bought the shares quite a bit lower, around 200 or so. I think it's reasonable to look at around a 0.2 to 0.3 delta on the covered call side. So one possibility is to sell the 250 call. So again, I'm buying the 230 put for protection. I'm selling the 250 call. I'm going to click the bid to sell it. And then our net debit is about 107 or so dollars. Not necessarily the end of the world. And it gives you quite a bit of protection. So where's your protection? It's in the bought put. If Apple happens to drop below 230 at expiration, it will have some value to it. And if it happens to drop to say 225, then this would be worth a premium of $5 or $500 at expiration. We're not looking at implied volatility or share price as well. So it gives that downside protection in case it does drop a bit, and this could profit even more off this individual trade. If it dropped below 230, the 250 covered call would expire worthless. You kept the full premium that you took in, and then the bought put will have some value with it as well. A few things to consider is to look at your strike prices to see how much of a debit you're willing to spend to use this as almost an insurance policy. Again, if you buy the 235 really close to at the money here, it's going to cost you more money, about $545. You might have to sell a call closer to the strike price, maybe 240 or 245. It does limit your gains though, because if we go above 245, this covered call would get exercised and you'd lose your shares. Although you should be pretty happy with that overall, especially if you bought the shares at say 200 or less, and then you're agreeing to get rid and sell your shares at 245. You also do get to keep your premium that you took in. In this case, it would cost you about $120 or so in the insurance of buying that at the money put. So again, I think this situation is usually pretty useful If you already held the shares for quite a while, you could look into this if there hasn't been too much of a big gain on your actual shares yet. If you just want a really good amount of protection here, I think it's perfectly reasonable to do a trade like this if you did just buy Apple. It is a pretty bullish strategy in general, especially if we're selling an out of the money covered call, because your max profit would be if we went above the sold call price. So, if you've been seeing some of my recent videos, I've been doing more of the investing versus trading side and leaning a little bit more on trades that are more on the investing side, being okay with taking time on these trades, not having to do trades immediately with 0 DTE and whatnot, although I do those strategies as well at datatraders.com. Looking for covered strangles, and I'm going to do quite a few more videos on that in the future. It's going very well so far. In my covered strangles, some of my covered calls might get exercised and called away, which is perfectly fine because it gets the max profit. And pretty much all of my short puts that I sold on the covered strangle will expire worthless as well during this Friday during OPEX when I usually make my trades a month out. So if you're interested in all these type of strategies, again, more of the trading side, 0 DTE and whatnot, and some of the longer dated, little bit more hands-off type trades that you don't have to be glued to your computer every second of the day, you want to look at datatraders.com. Appreciate you guys watching this video as always. Thanks for all your support. Click like and subscribe. Definitely helps out the channel. And I'll see you guys on the next one.